You guys asked me to go over some bond market questions, so I'm going to go through an example of a bond market question to walk you through the logic. So the question we're going to look at is, what happens to interest rates on corporate bonds when Congress issues more of their bonds? And we of course know that Congress issuing bonds, those bonds are called U.S. Treasuries. So we have our U.S. Treasury market, and we want to know what happens to corporate bonds. And of course, corporate bonds is just a bond issued by any corporation. So we're going to use Toys R Us bonds. So the first step in any question is always to ask yourself about the supply curves, because the supply curve is a little bit easier than the demand curve when it comes to thinking about bond markets. So based on what the question says is going on, the question is Toys R Us issuing more bonds, or is there any reason that Toys R Us might be taking in bonds at the end of their time without issuing more? That could also decrease supply. And the answer is no, Toys R Us is not issuing more bonds. But we see that Congress is issuing more of their bonds. So that means that our supply curve of U.S. Treasuries, Congress's bonds, is going to be increasing. And of course, this would happen when Congress needed to borrow some money to finance a highway project. And they borrowed it from the public by issuing these IOUs. So we've got our first step in there, and now we need to ask ourselves about the demand curve. Well, there's nothing going on in the problem other than this shift in supply, so now all we need to do is to look at the ramifications of this, this change in the supply of U.S. Treasuries. So we see that the price drops. We have our old price and the price decreased. And when the price decreases on U.S. Treasuries, that means the interest rate is going up, because those are always inversely related. So the question is, what's going to happen over here in this market? And we've already decided the supply curve is staying the same since Toys R Us is not issuing any new bonds. So we really need to just ask ourselves about this demand curve. And we know that these two things are substitutes for one another. People put some of their money in U.S. Treasuries, which are super safe, and they put other parts of their money in bonds like Toys R Us bonds, and that's just a way of distributing their money across different assets as a way of diversifying. But of course, when the price of a substitute goes down, that means people are going to look at that and they might want to move some more of their money into this asset, which is now cheaper. So we're going to get movement in between these two markets, just like we've always seen in markets for substitutes. People take their money out of Toys R Us bonds and buy up these new, cheaper U.S. Treasuries. And when they do that, of course, our demand over here is going to decrease. And that happens because when people take their money out of Toys R Us bonds, that means they're trying to sell those bonds or get rid of them. So anytime people are selling bonds, that's going to decrease the demand. Or another way of thinking of it is Toys R Us bonds are less attractive than U.S. Treasuries after the price change. So people are sort of moving their money to the more attractive item away from the less attractive item. So what we have over here at last is we have a decrease in the price of Toys R Us bonds, and that's going to cause an increase in the interest rate on Toys R Us bonds, which is the answer to the question.